Investment analysis. Here we have some simple time value of money calculations. For instance, here we have 100,000 times 1 plus 0.16 to the 10, which will give you the value of $100,000 invested at 16% for 10 years. Here we have the future value of an annuity of $100,000 invested at 16% for 5 years and put in with $100,000 going in each year. So you're to complete these 6 time value of money calculations. And here we have capital budgeting, where we're calculating the net present value of an investment. In this case, the purchase price is $400,000. The capital cost allowance rate is 30%. The marginal tax rate is 25%. The discount rate is 12%. Each year we're getting $180,000 in from the investment, and we have $40,000 going out. And in the end, we have a salvage value of $166,600 at the end of year 3 or the beginning of year 4. The first thing we need to do is to calculate our CCA table. Due to Canadian tax laws, the earned appreciated capital cost in the first year is half of the purchase price. So it's $200,000. Our CCA rate is 30%. So if we multiply CCA times the marginal tax rate, we'll see that our tax shield, or the amount of deduction we get for the purchase in that year, is $15,000. We then go back to the original purchase price, subtract the CCA in year 1, and you'll get $340,000. Multiply it by 30%, and your tax shield is $25,550. You then go 400 minus 60 minus 102, so you have $238,000 left of undepreciated capital cost, times 30% is 71.4, so our tax shield is $17,850, and we're left with $166,600 of undepreciated capital cost, which is what we actually sell that for as a salvage. So in year 0, we put out $400,000. In year 6, we get back the salvage of $166,600. In each of the 3 year 1, 2, and 3, we get $180,000 minus $40,000 times 1 minus the marginal tax rate. That's what we have in our pocket. So we have 180 minus 40 is 140 times 1 minus 0.25 or 0.75, which is 105,000, is our after-tax cash flow for 3 consecutive years. And then our tax shield is just coming down from here. We then add across these 4 rows to get our after-tax cash flow. So we put out $400,000 in year 0. In year 1, we get back 120. Year 2, we get back 130. Year 3, we get back 122,850. And year 4, we get back 166,600. Since we have to wait for that money, we're going to discount it. In this case, at a discount rate of 12%. So the 400 isn't discounted, but this one is discounted 1 year, 2 years, 3 years, 4 years. And so we get the present value of our after-tax cash flows. We sum those up, and if we get a positive number, then we are at least achieving our discount rate, or the rate of return that we're looking for. So we have a positive net present value, which suggests we have a return higher than the 12% discount rate. And if we want to know what that return actually was, we can go back to the after-tax cash flows and use the equation IRR and then highlight that, and that will tell you exactly what the return has been.